Hello everyone and welcome to Pivot Boss Masters. And in this presentation, we're focusing on entry techniques. So in this core training for execution portion of our Masters training, we're talking about entry techniques. And for the most part, what we're going to do in this segment is introduce some of the core entry techniques that we use. And then from there, we're going to focus on identifying certain signatures in the market that really help us identify major tops and bottoms. So for the most part, we're going to look at some of these entry techniques that I really love to use, the core techniques that anyone can use. And from there, I'm going to show you the types of signatures I look at or look for in the market to identify great tops and bottoms and engage them with these entry techniques. So let's go ahead and get started. So the Pivot Boss method utilizes a variety of entry techniques that are designed to provide consistency and increase profit potential while reducing risk exposure and limiting adverse excursion. It is up to the trader to determine how and when to use these techniques for any given trade scenario. And so, as I mentioned before, we have several core entry techniques that we use. The ambush entry, the retest entry, there's order flow based entries, and then several key level entry scenarios. There are various other style of entry techniques that we can follow as well. And you can go to the Swing Trade Pro 3-part course, and that Swing Trade Pro course has various other entry techniques as well, like a 30-minute opening range entry, 30-minute opening range breakout, 30-minute opening range reversals, ambush, retest, all kinds of different types of entries. So there's various entry techniques that we're going to talk about throughout the scope and throughout the rest of our master's training as we move along. But with regards to this particular course, we're going to look at using the retest entry and using it with the absorption signature, which is going to be a very powerful combination, I hope, for your trading both in intraday and in end-of-day purposes. Because when you're able to use a retest entry with the absorption signature, beautiful things can happen, because when those things line up very nicely, major market moves occur, and you want to be a part of those moves. The great news is it's very easy to spot those opportunities, and we'll talk more about that soon. So the entry types, again, the ambush entry, this one is executed by placing a limit order at a level where price has yet to trade in anticipation of a reversal or fade. So again, I know many of you are seasoned professionals and this is like old hat. Some of you are very new and green to trading, so that means nothing to you right now. Hopefully it does by now, but you know, that's the level that we have sometimes. Some of you are very experienced, some of you are not. Ambushed entry right here is basically a limit order. And so when you have a resistance level up here, and say this is the previous session's high price, for example, and you're anticipating that price may see a rejection at the previous session's high, then you would put a limit order at that price, a limit order to sell, a limit order to sell. So when price rallies into that level, it's going to transact that limit order and fill it at that price if there's obviously demand there. Because you're selling it, right? So you want price to come up and you're looking to sell that level. And so in order to do it without you having to do anything as the level approaches, you just set a limit there. You set a limit. And that's an ambush entry where price has not tested that level yet and it's going to get you in right there. Do or die. It can even go through, it can do whatever, but it's going to get you at that level, fill it or better. A retest entry, this is the one that I use most often. Ambush entries, you have to be very careful on how you use those, because if price comes up to that level and fills that limit and it hasn't tested it yet, it could just slice right through that level. So you have to make sure that that is a significant area that is very likely to see rejection. And some of those areas include significant composite low volume nodes. It includes prices like the overnight pivot or the midpoint or the previous session's close or the open price. Those prices, if they go immediately bid, or immediately offered right away, when price comes back to those areas, it makes for great areas for ambush entries. So when price comes back, it makes for a great area for an ambush entry. But if it's not a highly confirmed area, you have to stay away and avoid an ambush. That one's very, very difficult sometimes to really get a good grasp of. And, with ambush entries, I either got great entries or after looking at the entry and getting stopped out thinking that was no entry at all. So you have to know the style to use at different points. And we'll look at some examples of some of these charts in a little bit here, but there are times when an ambush entry is a great call, and there are other times where it is not. We're going to be focusing more on the retest entry in this time. It does seem like the ambush entry is more of a gamble at times. It really does. And again, that goes to being able to really confirm the level that you're going to be ambushing if you're going to use that technique. The retest entry is executed by placing a limit order at a level where price has recently traded in anticipation of a reversal or fade. So in this case, what I'm looking for is if price comes into a resistance level, I'm going to let price hit that level first, and should a rejection occur, then I'm going to look to set a limit order somewhere in that rejection zone for a retest, in anticipation of a retest that I can then defend and enter in that trade. So a retest entry allows price to hit a level first, and if price is rejected off that level, then look to enter upon a retest of that level or of those prices that were absorbed or rejected. That's the one right there, the retest entry, where if you look at my trades, it's probably 98% of the time it's a retest. Order flow entries, and this is basically order flow confirmation in the footprint chart, and basically requiring this type of confirmation before you enter a trade. And order flow entry is what we do all the time in the room, and basically order flow entries can be entries and triggers in and of themselves, not requiring any other participation from any kind of other levels or rejections at levels, because order flow is the rejection, it is the acceptance. And so order flow entries, again, we're going to talk about a little bit about those as well and how they relate to some of the other entries. And this is what we've been doing in general, especially as we incorporate more footprint analysis into our training. Key level entry scenarios, again, every time we put a Pivot Boss key level out there, these key levels mean something because it shows significant prices that the market rejects. And when you understand where these areas of rejection are, you can then look to those areas for fade opportunities, or you can look for expansion opportunities beyond them. And so understanding the types of key level scenarios and the types of reversals you see at those key levels really helps with the pattern recognition of what it takes to trigger some of these entries. So what's great about these entries, again, it's like everything else. It's all scalable. These are great all-purpose entry techniques that you can use, again, in all time frames. They can be used for any type of setup and any type of trading opportunity. So again, I use the retest entry for a super precise scalp, and then I'll use a retest entry for a higher time frame swing trade. It really doesn't matter, because the market will react to these levels the same way in every time frame, because the market is the market. Fear, greed, uncertainty is traders. It's groups of traders trading. So the market will create these same types of reactions in any time frame, and you can trade those reactions using these entry types. What's great about these entry types, again, is when you have an approach or a technique, a concept that you can use, it forces you to be disciplined, right? If you say, I'm going to use a retest entry, it's saying right there, I am going to use a certain technique with discipline that requires this type of execution. And it forces you to be disciplined. And it forces you to engage every single opportunity the same way. And that was something that took me a long while to really come across as well, is just the consistency of execution. From any given trade, from day to day or trade to trade, I would manage that trade in a completely different way. I would find the targets in a completely different way. And if you're approaching every single trade in a different way, there's no consistency. And when you have a lack of consistency, how can you attain consistent results with regards to profitability and seeing your equity curve go up and to the right? It's hard. It's hard to maintain consistency if you don't have a consistent approach to execution. And so again, this forces you to be disciplined, and creating those habits that consistently lead to successful trading is very important with regards to trading. That's what we talked about before, the risk management process. Identify a risk, assess that risk, control the risk, and then review the controls. And this is the same thing. It's being able to understand that if I'm going to use this entry, you have to be able to execute it. If you can't execute an approach, that's a risk that you have to be able to identify, diagnose, and then find a fix around. Because again, some people are scared to pull the trigger, or some people are scared to take a loss. So instead of getting out of their trades, they hold on to the trade past their stop. And again, a way to combat that from a risk management process or standpoint is to automate it then. Automate it. If you enter a trade, then your broker already knows that you're going to use a 211 exit technique, and you're going to get 10 ticks on the first target. You're going to look to get 20 ticks on the second target, and so forth. And so you don't have to do a thing. So again, the discipline is very, very important when it comes to entry, exits, and everything when it comes to trading. These are designed also to create more profit potential. So that's very important. As I mentioned before, when it comes to these entry techniques, there's a secret. And you can see the tips on the right here. The secret to making more money out of each trade is trade location, right here. And that's another little aha moment that I started to figure out. And again, it goes back to me and analyzing data, and creating algorithms and creating strategies and analyzing the data behind the results. And, I learned very quickly that if I can get a better trade location, I can squeeze more profitability out of a trade. Instead of hoping that the trade is going to go farther in my direction, pick up more of the trade at the beginning of the trade. So that's what these techniques are designed to do. An ambush entry is forcing the market to come to you, right? So you're exhibiting patience there. A retest entry, again, is forcing the market to come to you. An order flow based entry is analyzing the market right now, not historical levels. So these are all supposed to help you get into a trade at a great spot, so you can make money on the front end of the trade, and then take on little adverse excursion, and from there allow your trade to mature into hopefully a profitable winner. But what I mean by that, for example, if you want to look at it here, if you have a rejection tail, this is what I write about in my book, Secrets of a Pivot Boss. You have your wick reversal signal here and a rejection tail. The first and primary thing I do is the retest entry. So if you have a rejection tail, I'll put my retest right in the center point of that candle, or right at the center point of the tail, and that's where my limit order goes. And that's my retest entry. And so now if price opens the following session above that entry and then comes down and triggers that entry, that oftentimes is an amazing spot right there. It's an amazing spot that gives you little heat, little adverse excursion. And again, you're making money on the front end of that trade, because when price opens, it's coming down. Most traders are looking to trade beyond the previous session's high. They're getting it up here. Instead, we're making that front end money right here and extending the profits. So when I say entry techniques are designed to help you increase profit potential, that's what I mean. It helps you make money on the front end of that trade. These techniques are also designed to help you reduce slippage and limit risk. And again, that's all done by using limit orders. So if you haven't used limit orders and you've been on market orders, once you get into a few fast markets, you'll understand why you got to switch over. Using market orders was detrimental to my trading and our trading in the various managed accounts that we were using, especially in thin markets. When we were trading the S&P 400 futures contract, it was so thin that we would get slippage sometimes that was huge. I mean, $50 a contract slippage You know, and that's huge. I mean, how can you make any money with a small day trading edge by taking that type of slippage? But by using limit orders, again, it helps to reduce that slippage. And again, by reducing slippage, that's putting that little bit of money back into your account. And these are designed to inspire confidence also, because once you get a couple of these fantastic, incredible entries, and you're able to pinpoint some of these areas and you get in, you start feeling really good about yourself. You start really feeling really good about your process. And again, you have to really be able to manage success at times, as I've made all too well known, that, you know, if you get too successful, you have to stick to the approach. Don't change the approach, because that's when larger equity drawdowns will occur. That's when you'll be humbled by the market, as they say. Let's see here. But oftentimes price makes a lower low or higher high after hitting my limit order set for retest engine. Yes, I've seen that play out as well. And Nini, that's something that's bit me too. And then sometimes that happens, right? And I think what you're saying is, you know, you get a rejection here, so you put your thing here, and then it just goes down anyways and hits the loss, right? It triggers it here and grabs you here. I believe that's what you're saying, and sometimes that does happen. And I've been a victim of that many times, and that's why I said before that when something like that happens, and I've made mention to it, especially in the premium trading room, that if you do enter right here, and then price starts to trade in the lower third of this candle, it's likely going, I mean, 90% of the time, it's going to continue going, because this is supposed to be rejection. That tail is supposed to signify rejection. And so if prices are trading in the lower third of that candle, obviously that's not rejection. And so in those cases, it usually pays to just scratch the trade wherever you're at instead of taking the full loss. And that's where I mentioned before, instead of taking a full loss, I learned to just get out, because there were so many times where I would get in right here, and then it tries, and all of a sudden it gives it up, and I'm like, oh man, I know that's going to hit the stop. I know it. But I stay in anyways, and I let it hit it. Why? You know, so I stopped doing that so much. So if I did have a stop loss down here, instead of taking it on all the way, if it did trigger here and started trading in the lower third, then I would just take it off there and retry again, or find something different. So that does happen sometimes. So you have to be very careful and really confirm with order flow in that case. And that's where the order flow becomes very important. You know, you want to be able to see that there are trapped participants there that are being absorbed. If not, then that could tell you right there that that's probably not going to hold out. So watching this thing on an order flow basis will help with that. So some of the entry tips, again, the secret to making more money out of each trade is trade location. And being patient is very important, because, again, if you're too aggressive in these trades, that's when you can get trapped. Again, oftentimes it's these aggressive participants that we're tracking. If they become tracked beyond a support or resistance level, you know, it's the limit orders, the passive buyers and sellers that are trapping those aggressive participants. So being patient and looking to execute orders at the best price is always the best idea. If price gets away from you and ends up being a great trade and you didn't get in, that shouldn't be a bad thing. That should be a great thing, because you identified a great area, a great setup. It just didn't hit the entry. Too often, I think traders get sad or mad or angry or annoyed that they didn't fill that trade that turned out to be great. But those types of feelings lead to more types of feelings like that. So instead, you got to flip the mindset and say, you know what? At least I identified the spot within 2 ticks, even if I didn't get filled. How many people can do that? And let's try to get it next time. And maybe you might front run it by a tick or 2 next time, right? So you got to be patient. You should negotiate your trades. Negotiate your trade like you're bidding at an auction, because it is an auction. Be picky and bid low and offer high, and always try to get the best price possible. Again, that's when I really started shifting my approaches, and it was all because of my algo design background. You know, I kept seeing every single time, if we had a trade here again and we were looking, and, you know, every single time they wanted us to execute right here, market on open. And then I would see it execute there, and I would see price come back down. And immediately in these trades, we'd be underwater. And I'm saying, listen, we got to stop this. And instead, let's come back. Let's, yes, trigger the signal, but let's be passive. Let's wait for it to come back. Let's scoop it up lower and then come on with the game. Let's go, right? And so negotiating in that way was a big deal. The thing about buy-sell imbalances that I struggle with understanding is seeing what looks like a buy imbalance after price fades away a bit. It comes back to it and through the initial buy imbalance. I guess this is the art side of trading comes in. That's right, Southpaw. That's a great point. A lot about footprints and imbalances. It is an art, and it is fluid. It is a fluid situation. You know, there's more orders always coming in right away. What starts out as a buy imbalance, a minute later could end up being a sell imbalance because it's still, there's order flow going through those, that bar. But the one thing that always helps me is that I'm not looking at the footprint chart at every single price level. I'm only paying attention to the footprint when we're at a point where I believe a rejection is going to occur, where I believe some event is going to occur. So if price goes and approaches the previous session's low or the previous session's high, that's when I want to be watching the footprint. If the price is trading around VWAP, then the footprint may or may not be helpful. So it's just you identifying those zones again where the footprint's likely to be most helpful. And again, it's those rejection points: new highs, new lows, previous highs, previous lows, LVNs. Those points, even around value, can be very, very helpful. But again, not every footprint chart is helpful. You gotta be looking at the edges, at least from my perspective. So right here it says know your risk before you enter a trade and how you will mitigate it. Again, that goes to our trade management techniques. Be consistent in your entry techniques and create strong habits. So again, it goes back to that consistency. And then sitting on your hands is also an option, and usually the best option. And I talk about, especially in my book, Secrets of a Pivot Boss, that the best quarterbacks in the National Football League reserve the right to punt the football. Instead of throwing an errant pass or whatever the case may be, instead of turning it over, punting the ball is an option. It is a viable strategy. And sitting on your hands is a viable strategy. If you do not feel good about the order flow, if you don't feel good about that level or what's going on or something doesn't look right, you don't have to trade. If the day is dead or quiet or there's some kind of anticipation of forthcoming news, you don't have to trade. And so that's very, very important as well. When I stopped engaging the market so much is really when I felt a lot less pressure to perform, and I could just analyze the market and let it come to me. When I was always saying, today's the day when I'm going to eat everybody alive and I'm going to go at it and I'm hunting for a trade, oftentimes I was too aggressive. So by the time I got the first 2 or 3 aggressive trades out of my system, I was already underwater. And now when the good trades came, I was gun shy, right? So it's about just being patient, knowing what you're looking for, and just executing when you see what you're looking for, recognizing that pattern and reacting and triggering an entry. So when it comes to triggering entries, I have something I call the execution process that I go through. And the Pivot Boss approach to entering any market with precision involves this entry execution process, which basically includes forecasting, visualizing, and executing your bias. And this process can be used by all traders in all time frames to sharpen your ability to execute trades with better precision. And the entry execution process is really, again, what I talk about all the time. Forecasting, being able to forecast where price is likely headed. Even if you're wrong, every single time you forecast, you always get some sort of information about your forecast that you can tweak and make better and better. This is something that I think I got really into as I was a much younger child. I lived in an apartment complex, and next door was a UT graduate student, or a UT grad. I graduated from the University of Texas at Austin, a business school student, and it was fresh out of college a few years. Got a great job at Shell Oil Company, and became good friends with him as a teenager, actually a middle schooler. And from there, he always taught me analysis, how to analyze things, that he learned in school. Even when we went to the grocery store, again, that's where I cut my teeth. He'd show, hey, look at this 6-pack of Coke versus this 12-pack or 24-pack, and look at the differences in prices and analyze what it means and which one's a better value and this and this and that. So I was getting this training as a middle schooler. And that's kind of the process that I've always done. So I've always analyzed a situation or event, and I've always made predictions and forecasts, always, as far as I can remember. And I've gotten really good at it in anything that I forecast or predict. That's how I said before, my brother-in-law would call me up. He'd call me up on a Friday, and he'd talk football with me, and I'm sitting here telling him he'd talk about the Texas Longhorns, and I knew everything about them, every stat, everybody on their schedule. I knew if they were going to win or if they're going to lose. I knew if they were going to cover a spread and all that stuff, and I wasn't a gambler. I'm just an analyst. And so he'd call me up, and he'd talk me up, get information. And it was months and months before I knew he was actually betting on that analysis, betting on that information. And he and his friends were making so much money. And again, it's just forecasting. It's the habit and the practice of forecasting and making predictions. Over time, you get better and better and better at it. So the entry execution process starts well before with forecast. Where do I think prices are headed? Where do I think they could go? And then once they get to that price, are they going to see rejection? Because if they do, that's where I can look for an entry execution. So you got to be able to forecast these things. So you have to develop the ability to forecast where price may be headed, and specifically look for future prices where the market may encounter rejection. So auction-based key levels like the previous high, low, and close and LVNs offer great prices for rejection. So oftentimes when I'm making a forecast, I'm saying, hey, I think prices, since they're rejecting here below the previous week's close, I think they're going to rally to the previous week's high, right? That's your prediction. And I say, hey, since we're trending downward, we've been in a downtrend for the last 4 weeks. I think if we get to the previous week's high, I think that's where the market's going to reject those prices. So that's your forecast. And then you start to visualize. Okay, now you have to develop the ability to visualize how the market may move toward your forecasted rejection price, and visualize the manners in which price can or will reject off your forecasted rejection price. So that's what I said before. Once you make a forecast and you say, hey, I think price is going to rally to this level, that's where I want to look for a sell opportunity. Now you start visualizing, okay, if price rallies into that level, how's it going to look if it sells off? If price rallies into this level, is it going to rally into it like this? And is it going to immediately reject? Or is it going to rally and hold and then try to pop above and then fail up here and reject? How is it going to happen? Visualize those different manners in which things can happen. Because by visualizing that, you're able to then anticipate and recognize it much, much faster when it's happening so that you can execute much, much faster. So visualizing is very, very important. Anticipation, so anticipates the next one. Pay attention to how prices behave as it approaches the forecasted rejection price, right? Because this is very important. How is price approaching your area of rejection? So you have to be able to anticipate the upcoming trade opportunity by knowing if this is going to be an opportunity you can engage or if you should punt the ball and sit on the sidelines. So the anticipation phase is more about focusing solely on flawless execution of the opportunity ahead. And this is a very important part because this is a part where I struggled with before, where my attention would be taken away and I wasn't anticipating, and then I missed the opportunity because my head was looking at a headline, or I was watching CNBC because they're doing something silly. Whatever the case may be, I wasn't ready. Anticipate is being on the ready to go. So when price is coming toward that level or approaching that level, you're ready to engage and nothing else matters at that point. Everything else is kind of peripheral, right? You're just kind of looking straight ahead in tunnel vision and anticipating what's going to happen. Recognize, this is all about pattern recognition. Pattern recognition. So first you allow the market to react to your forecasted rejection price, and then you look to recognize a pattern of rejection as the market trades this price. Look to sharpen your ability to quickly and accurately recognize patterns of rejection. So if you know that there's certain types of rejection that you love to trade, then you wait and you sit and you wait for that pattern to reveal itself. If it does not, then you don't have to trade. One of my favorite rejections is when price is coming into a level like this and pushes through it right away. And then it drops down. And then here and here, it's absorbed. That's one of my favorite rejections. And then you see this happen. That's one of my favorite rejections, where price will push through a level, attempt to go higher, and immediately reject. And then when it comes back to that level, it's absorbed by passive participants. That is a fantastic, fantastic reversal opportunity. I will trade it every time I see it, right? Especially in higher time frames. And that's the type of signature I look for, especially to find major tops and bottoms. And so the ability to recognize an assortment of patterns of rejection allows you to know what to expect. So when you see that pattern start to develop, you can diagnose it and execute a trade based off of it. So once you recognize a pattern of rejection, execute in order into the market. Execute using one of the entry techniques that we talk about. Execute using a retest order, or retest entry, or execute using a threshold entry where we're using a stop market order. Execute using an ambush entry. However you do it, execute, right? Typically, you're going to be using limit orders. Sometimes market orders have their place as well, and that's when you'd be using a threshold entry. And then lastly, it's manage. The easy part, right? This is the easy part. Once you execute your entry, simply manage the trade. Simply manage the trade and allow your predetermined trade management technique to run its course. Win or lose, you did your job. That's the entry execution process that I typically follow. It's one that I've used for a long time, and that's why I'm able to react at these levels at times with extreme precision, because I already know in advance that I want price to perhaps reject at that level, and then I already know what I'm looking for once it gets there, and can diagnose it quicker than most people because I know what I'm looking for. Once you know what you're looking for and you see it, you execute it, and the rest is easy, right? Because the rest we've already predetermined via our core trade management techniques. So that's the process that I would urge you to kind of practice as you look to execute entries into the market. Learn to forecast, visualize, anticipate, recognize, execute, and manage. And it's a great process, I'm telling you, because it forces you to do certain things that I think trading just requires if you're going to get great at timing these things. And I wanted to talk about one of my favorite approaches to spotting significant tops and bottoms in the market, and it's the absorption signature. Many of you have heard me talk about the OTF responsive absorption signature that I often spot in the market. You hear me talk about it in the pre-market reports, in the closing reports. You hear me talking about it in the premium trading room. And now you're seeing me teach it here in the Pivot Boss Masters training. I've never really formally taught this absorption signature, but it's something that I'm very, very excited about revealing here with you today. The absorption signature is really a powerful, powerful signature that occurs in all time frames. And so again, this is one of those patterns that just happens whether you're watching a tick chart or whether you're looking at weekly bars. You can spot this absorption signature in any chart, any time frame. And so the ability to forecast and identify and diagnose this pattern when it's developing can help you identify the top or the bottom of either a short, medium, or long-term move. And so this is one of the major patterns that I've really used here over the last several years to help me identify major turning points in the market, including the recent market, which we'll see some examples of here pretty soon. So number one, the absorption signature, and this occurs when OTF, other time frame traders are those traders that use a higher time frame than you do to trade. Traders with bigger bank accounts, institutions, those types of folks. So when OTF responsive participants absorb a price level after a recent top or bottom, a distinct signature is revealed. and this is called the absorption signature. And this absorption signature helps to pinpoint major turning points in a market. Some of the most significant tops and bottoms occur with this signature attached in all time frames. And so it's very, very important to be able to identify this signature. And what I really wanted to do again in this training was talk a little bit and introduce the various entry techniques and the entry execution process. And then from there, talk about the absorption signature, which helps me identify major tops and bottoms in the market. And when you're able to then combine all of these approaches together, from the entry execution process of finding this signature to engaging it with an entry of a retest entry technique, and then managing the trade with, say, a 211 trade management technique, and then you see the big beautiful move pop off because you identified the right absorption signature. That's kind of marrying all of these various concepts to create a beautiful trade baby. I mean, it's glorious. It's beautiful. It's exactly what you want to see, and we're going to see some examples of this pretty soon. So this absorption signature, again, reveals itself in all time frames, but it all starts with a rejection day. A rejection day. So when the market probes through current support or resistance after an extended price discovery phase, but fails to establish acceptance beyond that key pivot, a rejection day develops. And this is a significant day in the market and typically develops a long tail event. And during this long tail and this type of rejection day, ideally you'll likely see some sort of signature, absorption signature, that comes as a result of this type of rejection day. And usually speaking, when you see a rejection day, a real one, the one you're looking for, it occurs after a price discovery phase and really pinpoints a top or bottom in the market. Like you can say, you know what, that looks like that's going to be the top or the bottom, right? That's that kind of signature. It takes for the entire day to play out for that signature to be, laid out in concrete and set in stone, but it's well worth it. Number 3, after the rejection day, after you identify the rejection day, OTF responsive participants will look to absorb prices at the absorption zone, which is a zone somewhere between the midpoint of the rejection day or the midpoint of the tail of the rejection day and the previous support or resistance level whose breach sparked the initial rejection. So responsive participants will absorb many rotations into this zone, which builds energy for the squeeze or liquidation to come. So this absorption zone can be different all the time, but it has a distinct signature. And it's this absorption zone that creates the signature that we're looking for. And that absorption zone, again, can be anywhere between a previous support or resistance level and the midpoint of the day, of the rejection day. And that's the zone to hunt, to defend as a passive participant in order to look to influence its prices in the opposite direction. There's also reabsorption signatures, and the market may see many reabsorption signatures throughout the life cycle of a trend. And these periods of reabsorption are designed to provide extra fuel to the existing ongoing price move. And after you see a significant reversal, a turning point in a market, you then look for those counter trend opportunities that occur within the existing uptrend. For example, you want to look at those counter trend opportunities for reabsorption signatures. So say, for example, price drops down and you see a major rejection day here. If we're looking for an absorption signature to develop and it plays out, and you start to see a move, then on a counter trend move here, perhaps you find and develop another absorption signature and it leads to another move. And so this can happen time and time again throughout the life cycle of a trend. And lastly, there's failed absorption signatures. And failed absorption signatures occur when passive participants get their stops run. And OTF responsive participants can and do have their stops run. And when they get their stops run, significant momentum moves do occur, big time moves. And so if it's an OTF participant and they're getting their stops run, you're likely going to see a resumption of the current trend as that major turning point actually fails. So we'll see an example of that as well. So let's go ahead and take a look at some of these chart examples. So we're going to start on looking at a retest entry with a scalp, and then we're going to talk about absorption signatures as we move along after that. So let's go ahead and start off with a scalping entry here. So we're going to look at the entry techniques for a scalp here. And the reason I bring this one up is because it's fresh. It's fresh from today. This actually happened during the current sessions market. And I wanted to relive this one because we got some great premium trading room replay video there that we have that we're going to accompany with this as well. And we'll accompany that video at the dashboard along with this section here as we continue to build out that backfill content. But this is a fantastic opportunity here that happens over and over and over again. And again, we were able to identify this live in the trading room and talk about each of the points in this chart as it developed and what we were looking for. And so what was great about this opportunity was we were able to identify the perfect spot there at 45.62 to spot an entry. How to determine stop loss? I talked about before having a certain amount of ticks that I use for each of the contracts I trade. But again, if you want a great answer to that and a different type of answer, if you go back to, so if you go to the dashboard and you scroll all the way down here to the bottom, it's Swing Trade Pro. And Swing Trade Pro right here has trade and risk management. And this talks about some of those scaling techniques, shows examples, and talks about proper position sizing and defining trade and portfolio risk. So if you look at this one right here and actually click on that thing, that little graphic, it'll pop up the slides. There's 69 slides. And so you can see right here in this section, part 3, it talks about forecasting targets, scaling and trailing, defining trade risk, 5 rules of risk management, proper position sizing, and defining portfolio risk. So if you scroll down here, it'll actually tell you how to go about deciding what your stop loss is. And so that's a great course right there that you can go back and watch. And I think it's going to give you some great insight into answering that question. For example, if say you wanted to, you have an X amount account. Say you're trading a $20,000 account, okay, and you only want to risk, 1% on any trade or 2% on any trade, right? So you would take 2% of 20 here, and that would give you what, $400? So if that's $400 and that's your max loss that you want to take, so if you're thinking your entry is going to be here, right, and you're going to trade, say, 2 contracts or say, whatever of the ES, then $400 divided by 2 contracts gives you X amount of points, right, or whatever it is, dollars, and you divide that by, so it would say, hey, you need to do a 4-point stop or whatever based off of 2 contracts trying to lose risking 400. Or say you want to do 400, 4 contracts, then whatever the risk applies, then that may mean, if you want to do that, then you actually need a 2-point stop. So that's what this part's going to teach you right there, and you can go back and backfill with some of that. But there's various techniques there if you're still trying to figure out what type of stop or where your stop is, because there's various ways to determine a stop. For me, I like to just keep it, hey, X amount of ticks. But sometimes, like with swing trading, for example, it's much more, it's not as easy. It's a little bit subjective because when you're trading stocks, and we'll look at some of these examples again, sometimes you just want to put it above or beyond the previous high or low, right? And so whatever distance that is then, so for example, say I want to get into this trade short because there's a great signal there, but my entry is somewhere here, and I want to put my stop above the high. So what is that right there, right? Whatever distance that is, determine the stop first. That's the distance. So now put that distance down, and that's your first half scale, right? So whatever, you make it equidistant to what your risk is. So make the first target equidistant to what the risk is. In terms of average range, you mean using an average range type of stop? Because you can do that as well. And I believe actually that this talks about it some more. And it's the scaling technique that uses a percentage of average range in order to enter, or rather manage a trade after you enter a swing position, for example. So there are various techniques like that, and again, they're in that portion right there, and we can talk more about those down the road and mark those up as well. So in this opportunity, what we were looking for was in crude oil. I said crude oil had rejected off the previous high, and now we're approaching the previous high right now. And so that was kind of the forecasting and visualizing where's the price where price could see a rejection, which price level will the market see a rejection in crude oil. And so the previous high was it. The reason why the previous high was it was because price had already rejected above the previous high earlier in the session, and now it was coming back again for a retest. So after having earlier rejected off that level and establishing early on that this was likely a trading range day, at least early on in the session, our expectation was that we would likely rally into the previous high, and if prices couldn't hold beyond it, we'd be looking for a rejection and perhaps a push back to VWAP value, right? That's the primary idea. So the first thing you want to see is rejection. When you're using a retest entry, and that's the one I caution everyone to use over an ambush, for example, at least early on. When you're using a retest entry, it requires you to be patient and allow price to probe through a support or resistance level and watch as it either rejects that level or finds acceptance. So you're just watching to see how price in the market reacts to those levels. And so once you see that price comes up here, and look at all of these buying balances, right? So that high is the same high right there, and these price points all match up right there. When price comes through the previous week's high, all of those prices right there were met with big buying balances, and yet price rotates lower. So you can see right here the little red stripe. That means that after price reached that high, it closed the bar down here and went offered through those prices, right? And so not only did it do that, it continued downward into this level. So that's where price rejects above the high, which is here, and drops into this level. That's a great first rejection off that zone. So what I mentioned in the trading room is the trigger entry, the scalping entry, is to now retest with a limit order at 62, wherever the absorption point was in the chart. So the prices that were absorbed right here, that's where you want to come back and test it with a retest entry and put your limit there. And so you can see price comes back up right here. That's right here. And it hits that portion right on the money at 45.62, sees a little bit of a buying balance, and immediately starts to drop a little here, right? And so that's it. That's what it looks like. That's recognizing the pattern. That is the pattern for this type of rejection. Price pushes up through a resistance level, finds huge buying balances, and can't hold above that level and auctions lower. That's a rejection. And so when price comes back to the level that saw absorption, it sees more absorption. Not huge, but it did see absorption on that pullback. And from there, you see the rejection, and then from there, this thing just drops. And so with precision, again, we were able to identify the price point. I called out 45.62, that was the high. And I said the first primary target is you want to have at least 3/4 of your trade off by the time we get to VWAP here. And if you want to try and get it across the range into the previous close, then that's like on the last quarter of that position, right? And instead, price rejected. So it came down below VWAP, rejected, came back, formed a higher low and rallied, and eventually it came back, right? But from a scalping perspective, this is about as good as it gets. This is about as good as it gets. That's all you're looking for sometimes. And as you see things happen like this, it's, because you can see this type of pattern anywhere in here, right? Anywhere you want it sometimes. But it's not anywhere in the chart where you want to engage the chart. You want to engage the chart at points in the chart where you believe there could be some sort of rejection, failed range expansion. That's the previous high-low close levels, previous high, previous low, previous close of the previous session, the previous week, the previous month. The open price can be one of those levels because look, here's the open price being offered, boop, right down. It tries to hold above the open, fails, comes back, boop, right down, right? So you can see there was a lot of areas up here where the market was reacting to. We saw the trigger we wanted, and everything played out perfectly, and we watched this thing just drop right on down. It was a beautiful thing, and again, that's precision right there. That's precision. That's a precision entry, a super scalp, finding the high. And again, just because you didn't trade this high doesn't mean you didn't catch the high, because the goal is for you to have maximum adverse excursion be as little as possible after you enter a trade. And so right here, it never went against our entry level. Never went against it. That's zero adverse excursion, and the thing drops in our area. That's extreme precision, and it comes from basic levels, basic levels, and allowing the market to reject and react to a level first, and then diagnosing in the footprint or the order flow or price behavior what's going to happen next. So very, very nice move here, how that turned out. So here's another example, and this is earlier in the day. So basically this is from the current session again, and this is forecasting and pattern recognition. So when we talk about our entry execution process, remember down here, forecast, visualize, anticipate, recognize, execute, manage. And this one deals with forecasting and pattern recognition. So again, the previous session here to crude oil, which you don't see, is that price had a big time upward price discovery phase in the session that preceded this. And so here, when you have a big time uptrending market and you set a high, a previous high here, and a previous close and a previous low, usually what happens is the market will test the high and fail and find a low and then create a trading range. So you can anticipate that a trading range day could be on the docket for the upcoming day. And that's exactly what happens. As soon as price comes up above the previous high, look at that, that's the previous high, it rejects, boom. It comes back below the previous close, it rejects. It tries again, it rejects. Here's the point we just looked at. There's the scalping point we just dissected. It happens again. And so you can see that when you have certain areas where you're looking to anticipate rejection at those areas, you just wait at those areas and you look to see what the pattern is. Because you never know how the pattern is going to look out. But if you can recognize several different types of rejection patterns, you can always kind of, have an advanced idea of what could occur. Because this is exactly what we were looking for. If price is going to push through a level, one of the patterns I want to see is a quick rejection below it and a lower high. So when we talk about different types of patterns and pattern recognition, here are three types right on this chart. There's a lower high rejection, a higher low rejection, and a lower low rejection. So here, number one, this is a lower high rejection. It goes higher, drops back, and then forms a lower high. You see that lower high right there? And then boom. And over here, it did it again. Rallies, forms a high, comes back, here's the lower high, and boom. Right? So that's one type of rejection. Over here, this is a higher low right here. So price drops down below the key pivot, bounces back above it, and then there's the higher low at it, and go. This one over here was a lower low rejection, where price drops, pushes back, and tries to hold and can't, so it has to come down and auction again, takes out those stops, and then snaps back in the opposite direction. Lower low rejection, right? So, and this would be one of those great ones to look for divergence as well. So there's various types of rejections at these areas, but again, sometimes it's not that hard. It's about knowing where to expect price reversals and then just knowing what to expect in terms of the pattern that's going to trigger your entry, right? In this case, we knew it could be a trading range day because of the uptrending price discovery phase that came into it, and then we saw trading range develop early on. So you should be looking to fade the edges. As I always say, fade the edges. So everything that's happening in here is of no consequence to me for the most part. I don't see it and I don't care. I'm up here. I want to see here. So we didn't really talk about crude that much. this morning, except for down here when I said, hey, price is below the previous close, and the previous close has been bid today. And then we see it go boop and boop. Then I say price is coming to the previous high. We could see a rejection and boop. Other than that, nothing here. That number 3 on the crude chart, that looks like it would be hard to find the right place to enter. This one is a tough one. This one's a tough one. The only one about this one here, we're going to pinpoint some of these down the road and draw up some blueprints for them. But the one about this one is that if you didn't enter a trade here, because if you come in here and you get this rejection up and then it fails and has to auction all the way back down, coming back to this level right here might get hairy. So you may be holding off. Who knows? But oftentimes the way I trigger this is not me so much expecting it. Sometimes I do. But it's not so much expecting it as just me being patient and just observing it happen. Because when you see it and observe it happen, you know exactly what's happening. Because here's a low, and as soon as price pops back below that low, there's an immediate absorption of some sort and an immediate rejection, and all of a sudden, mere seconds later, price is all the way back up here. And as soon as that happens, your immediate idea is that that's a short squeeze that's beginning, and that's the momentum that comes. So oftentimes, I'm looking more to engage this opportunity, a lower high, and this one over here, I happen to perhaps see it happen, and if I engage it, it's because I observed it happen. It's not because I anticipated it so much. Sometimes I may anticipate a lower low, but for the most part, I'm looking for something like this. So I wanted to show you what the retest entry looks like on a footprint chart engaging that same scalp. So right here, just looking at the footprint chart, this is an 8-tick range, 8-tick range here, and price pushes up, and you can see right here, this is where the previous high is. It's the 62s. So price pushes up through the 62s, and you can see immediately after it hits this zone, look at all those buying balances that come in, and price finishes the bar, that range bar, back below this high. So I don't know how many seconds that was, but it wasn't long. I mean, price pushed above the high, and by the end of the 8-tick range, it was down here. And then price continued down, and intra-bar closed here, and this is where the absorption began. So you can see as it approached, because remember when it rejected here and dropped, I said now what we're looking for is for the prices that saw the absorption, you're looking for that price to be the retest entry, and your limit should be here at 45.62 now. And when prices came in there, you see some buys, some buys, some buys. That's all absorption. And then boom, you see it drop. This right here further fueled trapped buyers and then unloaded their sell stops downward. And there's VWAP, 45.35. Highly confirmed 30-tick reversal right into VWAP. And when you can confirm and enter and execute a trade with no adverse excursion and get a 30-tick move in your direction, man, that's nice. That's really, really nice. Again, crude oil, 30 ticks in your direction, little heat, that's $300 a contract. It's very, very nice. So again, sometimes it's just about understanding where the market is most likely going to see rejections. That's where you want to engage the footprint and study, because everything else in the middle is just noise, just noise. So the footprint bar closes as part of identifying a rejection or possible absorption. Yeah, that's one thing about these right here is you can see the little stripe that comes in. That tells you whether that bar closed bullish or bearish and tells you where the high and low was, basically. So right here is where price opened that bar and it went up, and then it closed the bar here. So that means it went up first and then came down and closed here, right? So that's how you can kind of see intra-bar what was happening, right? It looked something like that. And so again, yeah, absolutely, that's how you would watch for absorption there, is how it plays out. I'm more interested with the rejection as well. You were in that trade at 62 and got out at 52. Fantastic trade. Fantastic trade, though, with precision. just precision. What a fantastic move. And, you know, a move back to 52s is basically when VPOC shifted up in this one. But again, just a fantastic move. Great entry, great execution. It really gets no better than that, I'm telling you. When you're able to see a rejection like that and engage it at the precise moment. And again, for those of you that have been in the premium trading room, this isn't the first time we've done this, especially with crude oil. You know, when we see those kurtosis events or some sort of absorption events that happen, I mean, we're able to say, that's it, and this is what we're looking for now, and watch that thing go on. So, I mean, this is just a fantastic approach, again, that, you know, you're waiting for price to approach a level, you watch it react at that level, and if you see a certain you know, pattern that you recognize that suggests rejection, you engage it with one of the entry techniques that we talk about. So again, if you enter this trade, say we get in with a 11 scaling technique. 11 scaling technique. So right here, that's your entry, right? And you get filled. Just say it was 2 contracts because it's 11 scaling technique. And you have a 10 tick stop. So up here, you're looking for 72s. So at 72s, if price goes up to the 72s, you're out. If price goes into 52s, right, you're out with a plus 10. And so once you scale and take off half at a plus 10, you can leave the original minus 10 exit. And since you made plus 10 on the first half, the last half at minus 10 gives you a break-even result, right? Minus commission. So once you scale at 52s here and you take off half the trade, your last half of the trade can come off at VWAP perhaps, right? That's why I said the bulk of the move when it comes to scalping, find a point of rejection and return it to value and be done with it. Be done with it. If this thing continues onward, you know, another 5 points or whatever, or in this case it's crude, so another 50 ticks or something, I mean, so be it. You can have runners as well. But at the same time, when it comes to identifying rejection, find rejection, return it to acceptance, and be done with it. And so that's what an 11 scaling technique would look like. You know, you trigger your 2 contracts here or 2 units. When it goes down plus 10, you take off half. When it comes back into VWAP, you take off another half. And boom, in and out, done. And it would be nice if every single one looked like this, right? Obviously, not every trade looks like this, but it's impressive how often rejections at our key levels do seem to play out like this very, very often. You see this type of approach happen often, very, very often. Okay, let's talk about the absorption signature. Now, I'm very excited about talking about this absorption signature because it is something, again, that I truly believe in because it has single-handedly, without a doubt, helped me in my trading, especially over the last, say, 4 years. With higher time frame engagements and even engaging time frames much lower. But the reason why this has helped out so much is because it does develop in all time frames. So if you can find this development in a higher time frame, for example, in this daily time frame of the ES, if you can find it, I mean, you can get significant multi-week moves in your direction with little to no heat at the outset of that trade, and then you see a nice continuation in your favor. So this is a fantastic opportunity here that anybody would love to engage. And really what we're looking for is an absorption zone. An absorption zone that we can jump into it where passive participants are absorbing off that level and some sort of major rejection may come in price. And so for the most part, what we're looking at here is we're looking for some sort of failed range expansion. So when price sees failed range expansion at some sort of significant area of support or resistance, the idea is to fade that failed range expansion for a major reversal in price. And so the way we do that is we identify a rejection day. This is the rejection day, right? Here's a rejection day. You can see those rejection days are very, very important. And so you can see here, this is the beginning of January. This takes us through the early March of 2016. Prices were dumping early in January and initially had formed a little bit of a support here, and boom, this big, big tail comes out, major sell-off, and by the end of the session, we had closed back above previous support. And when that happened, it was like, whoa, that's our rejection day. And so again, I can go back and pull the tapes for this, but after the rejection day, the idea was look to defend the midpoint of that level. And absorption, if it occurs in that zone, will likely influence price higher. And that's what happened. And price rallied right into our 39.5 target. Remember, we had 39.5, price hit 1940. We hit our target within 2 ticks. The reason I chose 39.5 is because from this low to that recent high, wherever it was the midpoint. That was the midpoint. So if this was a rejection day, after a significant topping rejection day, then we're likely going to snap back to the midpoint and create a key range. That's what happened. So that was part of that analysis when I talked about it earlier this year. I said this is a major rejection day here. So once you see a major rejection day occur at a significant price extreme, you look to then identify the absorption zone and where market participants are likely going to defend. And I mentioned before, that zone is somewhere between the midpoint of the rejection day and any prior support, where that rejection day probed through and then failed to hold below, right? And so that's the rejection zone right there. And so now what you can do is, again, identify where that zone is and look to execute limits at that zone in the upcoming session. You can do it as a swing trader, a position trader, and just put a limit and forget about the intraday. Or you can go into the intraday charts and be very active at those levels. Because on an intraday time frame, if you zoom in on what this day looked like on an intraday, it looks probably something like where it just hits over and over at that level before finally squeezing up the rest of the day. So you see plenty of rotations and absorption off that zone. Our limit orders where buyers, for example, are looking to absorb sellers, more commonly placed at one price level or at a price area, multiple price levels. Yeah, absolutely. There are multiple price levels. Sometimes it can be one price and sometimes it can be multiple prices. Because, passive buyers, there's not just one passive buyer with one zone to defend. There's multiple buyers, right? There's you, there's me, there's other institutions, there's other folks that are engaging, and we all have a zone we're watching. And so there are plenty of areas in that zone. And so that's why sometimes you'll see if this is the level right here, price can absorb in here or come down and hold, and whatever the case is, because there's a lot of different little prices here that are being absorbed. So it's never, well, I won't say never, but it's rarely just one perfect price that's bouncing like that. It's more of a zone where it's here, then a little higher, then maybe a little lower, then a little up. It's a zone where over and over they pound that level, and then eventually they exhaust one side or the other, and you see the stops get run. So this one right here is not actually as beautiful as some of the others we see. Like this one, for example, is much more beautiful. But nonetheless, this one was right on the money. We talked about this one earlier in the year, and it played out perfectly. And you can actually see that back at the premium replay when we talk about some of that back in the premium trading room. Over here, here's another absorption level. And this is OTF responsive buyers look to absorb supply after a rejection day. So you see this rejection day here. The reason why it's a rejection day, look at this 2-day support over here. There's 2-day support. Price comes down, 2-day support. But price can't go higher, so it has to auction lower, take out some stops before it can jump up. So that's where the rejection day comes in. It takes out the stops below these lows. Because remember, if you're a buyer and you bought right here, where's your T1? Maybe your T1's up here. So if lots of buyers have bought here and their T1s are up here, that's what's creating the resistance. That's why price can't go through. So in order to knock out these resistance levels and those limits to sell, you got to take out the buyers. And you take out the buyers by running the stops. So when price comes through and drops through, that rejection day is knocking out all the sell stops here, and it's taking these buyers out of their trades, which takes their targets, their T1s, and takes them off the trade. And now you open up the resistance, and now you're ready to go. So that's what's happening. That's what this rejection day is designed to do. And so once you see a rejection, ideally you want to see a long tail, right? This long tail. And ideally, you want to see price close back above prior support. So that's ideally what you want to see. See this one here? It closed barely above that level. Right here, it closed barely above these lows. That's what you want to see ideally. And when that happens, identify the midpoint of the rejection day, identify the previous support, and that's your absorption zone. So the point here between the midpoint there and this prior support, that's your absorption zone. And lo and behold, look at that little tiny wick right there. That tiny wick happens in the absorption zone, and then boom, explosion to the upside. And so that right there is one of my favorites. It's my favorite long-term pattern that can go into the lower time frames. This is what I look for all the time. We talk about it a lot, especially in the trading room. I talk about the OTF absorption. It doesn't happen all the time. It happens at significant tops and bottoms, right? And it also happens in the midst of an up-moving market. You know, you'll get them here and on the way down as well. But the major turning points, they look like this. If I see a rejection day here, and say I'm seeing this after the close, like right after the close, I'm not putting a limit right away, typically speaking. Typically speaking, I will let the overnight play out, and then I will look to put a limit there either pre-market or after the market opens. Because what I don't want to happen is have a limit here and, you know, it opens down here. You know what I'm saying? I don't want it to open against or open, because then it defeats the trade. The idea would be that if you have a midpoint here, price the next day has to open above that area and come into your zone. So that's really what you're looking for, typically speaking. Easy to see these looking back, but what about a current bar daily? So this, I think, is pretty easy to see as the thing is happening, because this is a significant event. This is the event in the market where everybody's saying, oh my goodness, this thing is going way, way down in the morning. And then by the afternoon, everybody's talking about how significant recovery the market had made, right? So this is a significant bottoming event. And that's how we're able to call these in the room and call them, you know, easily at times when they happen. And they have a process. So this is very easy to see right away. But you never know what this bar is going to look like by the end of the day, obviously, when the market opens. So when the market opens, it's actually a tiny little bar and it's a tiny little thing. You don't see any of this right here. You're only seeing this. So it looks scary still, right? It looks scary. But that's the way it's supposed to look like. And so when you see this part of the profile, we have a previous support and it pokes through and pops back above, you're expecting this to hold somehow. And so that's what you're watching for. You're watching for that to execute throughout the day. This one right here, yeah, I think you're talking about that one. This one could trick you to go long somewhere right there. That actually could trick you to go long, absolutely. And in this case, I remember when it happened, we hit 39.5 and sealed it. And whenever we failed to hold here, see, I mentioned you have to defend right there. And when we failed to hold that level, that's when we switched our bias and said that we were likely coming back to the lows. So this one came down and did a nice rejection, and then you see this happen. So yes, this could absolutely get, and did get some traders long, and then you see prices go offered. So it can happen. I think as we called this one live, we reached the key range target here, and then once price formed this doji and failed to hold this low, we were pointing for a move back down. So that's exactly our analysis as it happened live. I don't know if I ever thought that might be a buy zone, but it's definitely an area where it could have definitely gone. And buyers did come in and defend, because that's a pretty good spot. It is definitely a good spot, absolutely. So that could definitely be one. But I wouldn't call that an absorption signature, though, so much. I mean, it could be. But remember, an absorption signature, typically speaking, has to happen at some edge, you know, and this formed right in the middle of a range, right? But nonetheless, it was still very decent, very nice. So if you look at the absorption signature again from a longer term perspective in the ES daily chart, you can see we formed lots of different types of these along the way, mini ones and big ones. We obviously called this one in in our analysis for premium, and this one as well, right? And this is the one where we said, hey, I think we're coming back to 2061. And when I made that 2061 call, it was because of this signature. And so when you go back to the tapes of February, I was talking about the signature and how you're likely going to come back to 1941, which is, this point, or 1939, 1940, whatever it was. And if you can get beyond that point, then you work your way up to 61 to 77. And so it was all based off of this. So when I'm teaching this stuff for you, it's not just hindsight. It's not just, this is a beautiful chart example. This is real life. This is real life where we were in the room and I was providing analysis through pre-market and through all of these. And I was saying, this is it. This is what the signature looks like. This is what we're looking for, right? And so you can see it develop. So when I was able to see this is a low and this is a low, it was those absorption signatures I looked for, and then I played to key range targets. How you enter that trade, there's a million ways, right? The retest entry, and we'll look at some examples, is a great one. But if you're watching intraday, the thing to know about an absorption signature is it takes a while to develop sometimes, maybe a day, a full day, sometimes 2 or 3 days, and then you'll get the lift. So it can pound an absorption level over and over and over again. So if you're trying to day trade your way into a swing trade using an absorption signature, it can be tough sometimes. So oftentimes the best medicine is just to leave a limit there, from the daily chart perspective, and don't worry about the intraday. Don't worry about it. Put your trade management on it, see what happens, and just let it go. Because, again, if you zoom into this day on an intraday basis, it's not just a perfect rally. Before it rallied, it was down here doing this. So a lot of times, a day like this, if you look at it intraday, it starts like this, where you have, it starts, kind of like this. Way down here, and it starts like that, and it's doing this, and all of a sudden, by the end of the day, it's way up here. That's what it looks like, and the absorption zone is just pounded over and over and over and over and over, and then eventually it just gets released to the upside. And by the end of the day, the candle looks like this. That's what it can look like. So when it comes to engaging and executing an absorption signature, sometimes you just have to know, are you higher time frame, lower time frame, what's going on, and then know how you want to engage it. But a retest entry right at the midpoint is oftentimes the best. Here's a failed bearish absorption signature. So you can see we had recent highs right here, here, and here, and here. And this little tail comes up and pops up above that zone. And so when I see something like that pop up above a recent resistance here, I'm looking for that midpoint. And if we reject off that midpoint right there, you're looking to take it the other way. And so I remember when this happened, I said, that's not good right there. That's not good, and that's a signature that implies weakness that could bring us all the way back down. So I mentioned that day. I said, this is what's happening here. Now, the last saving grace for bulls, I said, was 1921s, which was, I believe it was an HVN at the time. And once we got a rejection off the 21s, price came back to the 21s, that was it, and a huge squeeze occurred. And so that was a failed absorption. And what I mentioned earlier, if OTF participants get their stops run, it's a significant event, because those are big-time players with a lot more money. That means that a lot bigger stops are coming out. So this failed absorption occurred, and you saw a big-time push higher. And throughout the time here, you can see right there, price holds. Look at this little support there and there. This right here is not a huge rejection day. That was actually the ECB day. So that's the ECB and Draghi, and it had a huge day and formed a major bottom there and closed back up here. And you can see how the market then absorbed off of previous support right there. So the market absorbed off of previous support after the rejection low. So that was still a rejection day, a rejection low. It just didn't look as beautiful as you're used to seeing. And then you can see it just lifted right off that area. And then when price comes back again to these lows, here's the absorption zone right there, and then it lifts up again. So you can see this in many, many different time frames. Again, if you can find this at a major extreme in the bigger market indexes, you can get some significant moves. Again, this is 1800 down here. That's the August low, and it was a rejection there, and that's how we were able to identify that this could happen. Then this was a failure at the August low again. That's how we identified this could happen, and if we could overcome here, we were looking for 61s. It all came about as of these absorption signatures, just powerful patterns. Here is the absorption signature in a stock, and this is NVDQ, and this is kind of a long-term absorption signature that develops sometimes that actually ends up being kind of an accumulation phase. And so you can see how price dropped here and held. And then this crazy day right there where you get a low below and a low above. So that was a big time day. And basically that rejection right there occurred and price popped back up. So every time it rotated back into that prior support here, it was defended in that absorption zone. And so basically everyone that got in short down here was now trapped, and they were stepping on top of those trapped market participants and eventually looking to gun the stops, the buy stops above the range of those sellers that were up here defending. And so this is kind of a long-term absorption signature that can happen over a period of time, but you can see it's all kind of the same. You have your left side, you have your rejection, then you have your right side. And what does that look like? It looks like a head and shoulders, right? An inverted head and shoulders. So that's kind of what you're looking for, is that type of rejection signature. And when price pushes through and sees the initial part of the expansion from the accumulation phase, when it comes back to the top of the range there, that's where passive participants will then re-engage and reabsorb those prices, reabsorb off that area, and then look to see a continuation higher as a result of that expansion. And something I always talk about, remember, compression leads to expansion. This is compression leads to expansion. And expansion leads to compression, right? And those are the same principles that we go by. And when you follow those same market principles time and time again, you're always going to be on the right side of the market for the most part, because those are the same core principles that just play out over and over again. So this is something to look for again with regards to accumulation and a markup phase, and looking at the absorption and kind of tying them all together, especially with regards to a reabsorption. Down here, with regards to trading something like that, the institutions will enter and then takes them off the table. When it comes back, they add back, and they take them off the table, and they add back, and takes them off the table, and add back, until they see expansion. And then they're looking to defend. So that's typically what's happening in there. Normally speaking, you wouldn't, as you or me trading, we wouldn't buy right here and just sit on that and see what happens. The idea is to actively manage this. And this is what we're going to talk about in our advanced trade management techniques in the upcoming session, is about actively engaging some of these zones and what happens in here. So it seems like in a long-term signature like that, a sitting order for a breakout would be the safest entry, but then where would a stop loss be placed? So with this right here, if you're looking for expansion up here, that's where something like an average range stop can help, like what was mentioned earlier. And we talk about that again some in that Swing Trade Pro. Again, this is also a point where I say that I like to engage some of these opportunities like a scalp. So if I'm in here and I identify that the retest is right here and that's where I want to engage, then when I trigger that entry, I'm entering it with scalp trade management. So if it goes up again, like if it was crude oil, 10 ticks in my favor, that's where you're going to scale. So this can be done in much the same way. You know, if you hold an initial 50 tick stop, then when price goes 50 ticks in your favor, take half off. And now you've scalped your way into a swing trade. And now you can keep this original stop and you're losing $0 if it hits it. So it's the same type of thing for the most part. Okay, here's another example here. And this is a retest after a rejection day again. This is in crude oil. We all know this example as well. So looking at this rejection day here, again, this was made very clear in the chart that we had a key range right here that we were watching. We watched price rally to the midpoint of that range. And again, this is all live analysis that we did in premium, right? And when price dropped and held below the low of this low here, the one thing I mentioned was, if this is a rejection day here, if prices push back above this previous low here, we could be squeezing all the way back up to this high, and perhaps all the way back up to the previous high. Because remember, this is a key range. That's the high, that's the low, the midpoint was somewhere in here. So from this rejection day, we were looking for a retest zone and looking to swing it back up. And so this goes back to, again, being patient. Being patient. All I did on this session was just basically, we got a break. We saw how this thing was dropping, so we were probably shorting it intraday. But then whenever we saw the late day rally and price closed like this, the way it is with a rejection tail, now we know exactly what to look for. Is this going to be a lower low fade? Is this going to be one of those divergence plays? If so, then let's look for a retest entry. We know where the trigger zone is. It's going to be the midpoint of the tail. So this is not so much an absorption signature as it is just a rejection day with a retest entry, right? And so this one doesn't test perfectly at the midpoint. So this might be one of those days where you might have to negotiate an entry above the previous session's high. And that's where, those threshold entries, again, talked about in Swing Trade Pro, come in very handy. And that's where you would put a stop market order above the previous session's high and look to trigger that in a momentum move up with the rest of the stops that are getting squeezed, right? That can be a scary way to intro trade sometimes. So you have to be very confirmed when you're doing it, but at times it can be a very effective entry as well. So whenever the market pushes beyond a key support or resistance level, I am looking for failure almost immediately. I want failure, because if we have failure, we have a clear indication on where price can go, back to the midpoint of the failed range and back to the opposite end of that failed range. If we do see expansion, then we obviously have zones we can target, but I'm always looking for failed range expansion first and foremost. And again, this was another one of those opportunities where we were able to call this low because of this rejection day, and we were able to forecast a nice move all the way back up. This is another absorption chart here, and basically what this one is showing is just the types of absorption signatures that you see. Because over here on the left, again, this is the NQ now. On the left over here, you see some support form, and then you see the ECB day, right? But this was an incomplete bullish absorption signature, because when price closed way up here, it never really came all the way back to the absorption zone. It was immediately bid back up and then continued higher. So I would call that kind of incomplete. There was a little bit of a rejection here. They absorbed a little higher, but then nonetheless, it still worked out. And then you can see how this one actually forms on a high instead of forming at a rejection zone. That's a reabsorption area, right? So while this formed after this little rejection here and we got to move up, this one is holding on highs, and you can see this is clearly bulls defending here and here and here and here for 4 days, keeping that support, right? And finally, in order to get this thing to go up, they say, we got to go down there and trigger some stops and then get a move up. So this is the rejection day right here. That's your rejection day. And so when price closes back above the rejection zone, look at how the next 2 days trade in that area, right? And they're defended in that area until you see varying degrees of strength on those 2 days. But that's the absorption signature, and just knowing what to expect can keep you on the right side of things. Now keep in mind, after 1, 2, 3, 4, 5, 6 days here where you're just sitting in that zone, if price doesn't hold, that's a lot of big OTF buyers that are going to have their stops run big time. So that's another thing to consider. If price can't hold and this fails, whoa, that's a big retest of those lows. Do I swing trade the futures contracts or the options on futures? You can do either. I do the actual contracts. But I want to incorporate more options. I've made no bones about that. I definitely want to incorporate more options. but I'm holding the raw futures. This is the one that happened here recently. This is the recent rejection, and this is the absorption signature on the high. And remember, we were talking about, and we continue to talk about, this expanded ripple. So the algo ripple effect, where it's rippled around these prices, right? And so what I kept mentioning the entire time was watch new highs, watch new lows, right? This new low, watch for us to go to a new high. If we find a high that punctuates the top of this move, we could be looking at running the stops in the opposite direction. Again, this is live analysis. This isn't hypothetical. This is what we called. This is what we talked about. And you could hear me saying, hey, if we can find a high here, if we can punctuate a high, that's what we're looking for. That was me forecasting and visualizing. And then here it is. There's the high. And remember I said that day, I said, wow, this is really close. This is probably the day. This is probably the high of this move. We just need to close below the previous week's close, which was somewhere like right here. And we did. We closed below that level. And I said, if we do close below that level, you see these highs right here? Those become your absorption zone now to defend and reject back down. And look what happened. Again, this is live stuff. This is live analysis that I've provided here over the last week that has led to this move downward. Now what's happening is, look, now another rejection down here. As we've expanded this cone outward like this, now we're down here. So are we going to see, some sort of defense here that leads us perhaps back up? We'll see. But we know where to look, right? We know that this is the midpoint. That's the prior support. Now we have a little bit of a level off 4400s to work off of. And now we can work to see if that plays out. But again, every single one of these points in the chart, this is live analysis here. This is actually what I called at that level, and you can see how it played out. And again, when you're able to identify with precision that point and then execute your entries using a retest or using whatever arsenal you have at your disposal, look at that move that ensues. It's pretty solid. Now, I'm not saying you'll always get every part of that move because anything can happen. I'm not a fan of holding overnight. Of holding over the weekend. And as you recall, I think this happened. We got a big gap down as a result of the weekend one of these days, I think. So, I mean, that type of thing can scare you off a little bit sometimes, is holding over a weekend if you're early into a trade. If you've been in on a trade and it's been popping up like this, I wouldn't mind holding over a weekend after I've gotten some distance in my trade, right? Because that's how you hold some of those longer positions. But if I'm initiating a short right here, I don't want to initiate this on a Friday afternoon, right? And then hold all over the weekend to see if this happens. That's not typically my style. That doesn't mean it can't work out. It just means, when it comes to managing risk, we can accept, avoid, transfer, reduce, or offset. I look to avoid starting a swing position on a Friday afternoon, right? That red bar before the green right-hand side of the chart started out as what would look like a bull absorption, being that the prior day had a big tail. Is this correct? You're talking about this bar right here started out as what looked like a bull absorption. So you're talking about like right here, perhaps? Right? Yeah. So this is one we talked about before. Yep, exactly. So right here we talked about, this is support and they were holding it here. And we were saying, wow, look at this thing auction right through. So one of the tells that price could go through this level is if price comes up here and fails to get beyond the high. Failed range expansion. So we talked about this, I think, yesterday or in the trading room, where in this case right here, it was defending off of this support, right? Here's a prior high, it went through, here's support, here's support. It was trying to defend off of that support level. We knew better, because we wanted to take out that low. It's not expanding if it can't take that low out. But that's what the market did. It tried to hold that support level. And this is the tell. Because ideally, you want price to open up, defend, and then go. In this case, price opened up, went up first, and rejected, and then dropped. Right? And there's a difference. It's an order of operations difference. Price went up first, and was rejected above the previous session's high. So that's when everyone said, I'm dumping, and the thing gunned the stops. So there's some micro tells that you can pay attention to sometimes, but that's what happened in that case. But in terms of an absorption, sometimes you really want to see, again, you want to see one big emphatic tail at the edge of a range, and you want to see some sort of prior or existing resistance or support on either side there, right? And watch it develop on that side. So here's Twitter. For those of you that are in the premium trading room, you'll recall Twitter here last month, and one of our members asked about looking at Twitter and what we thought, right? So I pulled up Twitter, and it happened to be on this day right here. I pulled up Twitter. It was the morning, so it was still in the morning session, and I was saying, hey, that's an area right there where we're rejecting. And I did my analysis on it, and I said, you know what? This is the 19s. And this is where prices went offered through there, and it's been defended here ever since. And price expanded through that level, pushed through it, and then saw a significant rejection day develop. And so I think one of our members was long Twitter at that point. And that's when I said, you know what, I think this may actually be a rejection point, and we may actually see a move against the range now. So you have to be careful and protect yourself. And so I mentioned if you're going to short this, here's the midpoint of the rejection day. That's the area you want to consider for a retest entry right there. And so you see how price opens the next day below the midpoint, rallies into the midpoint, rejects at that point, and then closes back down. And then from there, prices never came back. And as a matter of fact, I think prices are still way down here somewhere. So that was another one of those, again, rejection, failed range expansion, right? Combining failed range expansion with a retest entry on a rejection day is money, 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 money. Now, again, I always try to caution. I don't try to throw snake oil everywhere and say that this is going to happen and work every time. The market is a collection of opinions with order flow that changes things at any one moment. So at any one moment, any of these things can break down. But for the most part, when you're looking at stocks or a price movement that is very organized and very clean market structure and has great movement, when you see these types of rejections occur, you can lean on those and count on those that you may see rejection because you're adhering to these principles. It's not just any old candlestick. We didn't just say, let's trade this one right here, or let's trade that one, let's trade that one, or trade that one. Let's trade any old wick. What we're saying is this was a failed range expansion beyond 19s with a significant rejection day. That's the one we want to trade. And so you can see how perfectly that one played out. And this is our last one here. So again, this is another one where it identifies rejection days with highs or lows, and then from there looking to retest those rejection points, the midpoints or previous support and resistance levels. So in this case, we had a rejection day. And this is crude oil. And as you recall, here's the low of crude oil, and there was the high. And that was a major impulse range. And so we got an impulse range with a midpoint right here. And so once price got outside that range, if you recall, again, this is where I said this is a rejection day, and it's happening above the impulse range high in a bearish downtrending crude oil market. And I said look to sell right here. And I think the entry was like 50.11 or something like that. Look to sell that price point at that level. And it hit it and went past that level by like 4 ticks. And then prices have never, ever come back. And that's when price went from 50 to 26. And it never came back to test that price point. That's how significant that rejection was again. And again, this is not hypothetical where I pulled a beautiful point off in the chart. This is a point in the chart where I told everyone and showed everybody in the pre-market and post-market and charts at premium and said, this is it, right? This is it. And if this is a rejection, the primary idea was to bring it back to the midpoint of the range. And that happened right away. And then once it came to the midpoint of the range, look at how it rejected. So the midpoint of the range is about right here. It formed another rejection day at the edge of that range after this move down. And after this rejection at this midpoint where you've been catching a bid after bid after bid after bid, you can put another retest entry at the midpoint and look to see if you can get it back up into the range. And that's what happened there. So on these 2 rejection days, again, I don't care what's happening in here. This makes for horrible trading. Trade the edges of the range. That's where you can see the best rejections. That's where you can, time your entries much, much better. So again, this whole entire session here has been not about every single style of way that you can enter a market. We'll cover many more styles as we go ahead, but it's about those highest probability odds trades that I love to enter. Those major turning points in the higher time frames and the lower time frames, how to spot those significant rejection points, and then how to enter those areas so that you can get into some significant moves on a swing basis, and then use those same pattern recognition tendencies for those absorption days and translate it into a lower time frame. So in this session, we were able to cover some great precision scalping entries and then use those same techniques to identify precision swing entry techniques. And that's just something that you just can't do all the time. I mean, to be able to do that with our core training, it's fantastic. All the various aspects that we've put together over the last couple of weeks with regards to core training and all these various training courses that we've done, it's all putting it together now at these precise points, and it's just a thing of beauty. That concludes the entry techniques portion here of the core training execution portion of Pivot Boss Masters. And again, you can see how powerful some of this training can be at times, because these weren't just areas that I cherry picked off the charts. This is just what we've done here in the market. I don't have time to cherry pick everything and show great examples. I don't have the luxury of that time. I'm very, very busy. So that's why you see some examples from the current market, because it happened right now. There it is. Let's pop it up there, and that's what we're using because that's what happened. These are techniques that are just interchangeable that I use all the time. But the absorption signature is one of the most powerful signatures that I've come across in terms of accurately being able to identify not only a turning point in the chart, but also where to enter that chart. And again, it's just fantastic when you're able to combine an entry technique like that along with some fantastic trade management techniques. It makes for some really fun trading again, because it really takes the learning part out of the equation. You already know the style of entry techniques you want to use. You already know the setups you're looking for. You already know the order flow that you want to recognize to confirm your trades. You already know the trade management that you're going to use. Whether it's a 211 or 111, you already know the trade management. So once you know all these various aspects, then it becomes fun to just deploy those techniques in the market as these situations arise, and that's really where the fun occurs. So how did I arrive at that $19 level on Twitter? It was just resistance. Just quote unquote just. It was resistance. It was previous resistance after price had dropped through it, and so it was just a real clear rejection level. This is summer semester in college with a full load. I love that. I want to say thank you so much. Thank you everyone for being a part of Entry Techniques, a core training course here in the execution portion of Pivot Boss Masters. Again, the ability to not only understand which techniques you want to use with whatever types of setups you're using, but the ability to just practice and exercise these entries and executions, makes things second to none. Just makes it very, very quick, like a well-oiled machine. So I hope that you continue to exercise, practice with these various techniques, and hopefully they serve you well in the future. So thanks a lot for being part of this training, and I look forward to seeing you soon.